What's happening, Bill? We got people coming in. Ken is in the house. Oh man, you guys are just jumping in. Boom, boom. All right. So, just for anyone new, this is not a Zoom meeting, so it will be different. Nice, Ryan. We got a couple guys on our team. So Ryan, who's texting in chat, he's actually one of our pros also. And then Steven, who will be coming on a little bit as well. So to that end, there's a Q&A section. So if you guys have questions, and I'm just gonna use my machine gun keyboard here, send questions to Q&A section here. We got a lot to cover. So really quick, there is this course is going to be a little bit more advanced. So if you're not familiar with the basics of options, apologies. Hopefully you are. You can go to our YouTube page, just like search paper gains. There's basics of options on there as well. We had a kind of intro to options series before. This is going to be more like your options 200 course. So slightly more advanced. We're going to get to more of the nuances of how to actually profit and some of the secrets and tactics that we use. I call them secrets, but what I've seen really is that there's this, and I'm just entering this Discord network of traders, which I had no idea. I mean, it blows my mind. It's amazing to see the network, but there's a lot going on. And after trading for a really long time, and the pros that I trade with also, I can tell you, like, what I see works for a while, and eventually what happens is that people want to move on to the next kind of iteration or the next level of trading. And this is really what that's designed to kind of teach you to do. So we're going to start out with day trading options, and that's what we're going to cover today. What we're not going to cover, obviously, is like price action and things like that, and we'll get a little bit more into that. As far as what you should know and kind of some of the bases, it's going to be good to have an idea of the Greeks coming into this. If you don't, you might get a little lost, but you can always send a question, and then we'll try to answer it as we go live. For me, generally speaking, I run about an 80% win rate, 75 to 85% win rate. A lot of draws also, and I mean, the losses are significantly smaller than the win percentages. And what I've seen, like, here's just, if someone's looking to hire us as some of the server analysts, like we do have, this is just best week is $1 million in the week, verified profits if you wanted to know, but just some credentials. When I started trading, I made a lot of money really fast, and it was actually not even in equities. I eventually moved on to options, and I worked in Silicon Valley. I live in San Jose in the Bay Area, and if you're in tech, which I was, we made pretty good money. And it wasn't until I really got into the derivatives or options market that it actually completely changed my whole outlook. And I was like, wow, I can make these gains like on a very regular basis. For me, it was, a lot of my friends, customers, they're the guys that were taking Uber public. Snowflake was one of my biggest customers, Robinhood. And so it turned it out to be, they started asking a lot of questions. Dude, how are you doing this? How are you doing that? And I wanted to show them how I was doing it. Eventually they're like, no, these are really smart people too. They're like, no way, man, just do it for me. I actually went down that road for a little while, found out that it's kind of a fruitless endeavor. So running into this Discord community has been pretty awesome. So that said, hopefully you have a good understanding. Oh, we got a bunch of people jumping in still. Hopefully you have a good understanding of the basics of options, and you've already traded a couple at least. And people come into this situation where like, okay, well, I bought a call, the stock's going up, so I buy a call. Stock's going down, so I buy a put. And then after that, they're kind of like, what do I do next? So this is what we're going to cover through this course, right? And again, what we don't cover, right, is price action systems. I mean, there are a lot of systems out there. There are a few that work. A lot of them are kind of conditional. You guys have some pretty amazing server owners also that are absolutely helping everyone learn how to trade in general more efficiently. I will say for options, precision, there's a difference between precision and accuracy, right? So for options, you really need to be pretty precise in terms of your executions. And so that's what we're going to go through. The nuances of the Greeks are what really confuse a lot of people. In this webinar, it's really going to be how do you leverage those nuances to make even more? So I'm coming into this with a basic assumption that you're already at a point of stocks going up, buy a call, stocks going down, buy a put. Now it's like, how do I get those exponential gains? How do I get those same gains with even less risk? And that's what we're going to get into. A couple things to note. Actually, Steven, you want to just introduce yourself for a little bit, just so they get to know you?
Yeah, I'm Steven. I've been trading
really
a little over 7 years now. Started in the Forex market, moved over to options. Can you hear me?
Yeah, I'm sorry. That was my fault.
Okay. So yeah, started in Forex, moved over to options. Yeah, I've been with several different like training programs and everything. Jason really helped me take my trading and understanding of options to this level where we're at now, where it's a very complex strategy and using different strikes and options and stuff to, like you said, use a lot less risk and get even better gains, more consistent gains out of what we're doing. Yeah, so that's me. Like I said, 7-8 years trading experience.
Yeah, I think when I ran into Steven, and some of the best traders I know come from the Forex markets and from a technical perspective. And this guy was just like, man, kind of made me look like a crappy trader on some of these executions that he gets. But yeah, I just love the style. And we've been trading together for, I want to say a full year, like every day,
almost a year now.
Yeah, and Ryan's also here. I don't know if he has audio, but so Ryan, Steven, and I all trade together every day. We don't have any other jobs. This is our only income. I really don't make any money from this stuff. It's just to support the community. So if you're following, just know, hey, look, for us, it's different. We can't really gamble, so we don't have lottos, right? So since this is our income, if I lose some money, where's it going to come from? I don't have another paycheck coming in just to reload, right? So it's a very different style that you'll see for the most part. And so hopefully you get an understanding of that. So general trading. So have a system to trade price action that's separate and independent, extremely important, right? When we enter trades, we always have an exit plan. My old templates would tell you exactly what that was and have all the logic. The way that the bots are working now, I think it's a lot easier for people to start like following along or understand, but they're lacking a lot of that information. Just know that it is there. And we do take notes. Any pro trader is going to take notes on all of their trades every time. And your mental state, right? So for me, sometimes if you're watching, if I have a bunch of wins, I might just cool it off like for a little while. For me, that's personally like when I have a nice win streak, I take a step back, or I need to take a step back. Most of my losses, when I have them, they come right after some pretty big winning days. So know how you're thinking. Are you chasing profits and chasing I've used lightly, or are you playing for the upside, or are you overly cautious? Either one of those situations can be pretty dangerous. Outside of that, if you're learning, focusing on a few stocks, and you'll see like we trade Tesla almost every day. We'll trade certain that you'll see a lot of traders trade SPY every day. That's the type of regiment that you want to get into. Like have a handful of stocks that are extremely liquid, get to know them very well, and kind of focus on that. And then you can start expanding your kind of view. Always watch the larger indices. We always have like SPY, Qs, diamonds, all that kind of stuff. It's always on another screen. I'm sitting here in front of 7 screens. I don't know how many other people are doing that, but if we're trading for a living, that's the kind of stuff that we actually have to have. Know what the VIX is. That's your volatility index of the SPY, and general macro trends. We don't cover that. I just wanted to say it. Hey, this is definitely a thing where some of your server owners might actually be able to cover it for you. In terms of the trade logs, so the analyst bots in your servers, what you're seeing, that's a trade log. And I just, again, really quick hit. It's pretty invaluable. Having not had this when I was learning, I think it's amazing to have an opportunity to see into someone who does this for a living, into at least their head. Like I'm spitting out thoughts and things like that. Yeah, I never had anything like that. So if you're new to the market, you have an opportunity to to learn from a lot of really good traders out there, and it's pretty cool. What I would say is, these trades are our logic, my logic, right? If you're out there, if you're going to copy it, paste it, and plan on profiting it, you're going to be at a disadvantage. I use tools, tactics, Steven, Ryan, all the guys out there to get executions at like crazy fast speeds. So you're going to be at that kind of delay. So what I would say is, these are our logs. If you want to do with it what you will, but the value that I believe that is really there is just to be able to see the logic that we have and then kind of tweak it to make it your own. You might not understand some of the trade styles. That's fine. You'll learn that later on in this course, but adjust it to your portfolio and your trading style, if that makes sense. Oh, Ryan's there. Ryan, I'm going to give Ryan a quick. Yeah, Ryan is probably our most veteran trader. Okay, Ryan, you should have ability to talk. There he is.
Yeah, I just got that.
Boom, there he is.
Can you hear me?
I can hear you.
Nice.
Just quick hit on who you are, how long you've been trading, and your kind of experience.
Yeah, real quick though on Jason's last point, what he's saying is basically own your trades. Use our trades. We definitely love when you take our trades and make money, but own the trade. Take responsibility for everything that you do, and it'll help you a lot. As for me, I've been trading since I was started off actually when I was 14 years old with the newspaper and calling it in on the phone. So yeah, I've been in the game for 20 years now. I went to school for it at Ohio State. I've done it professionally. I've worked on the floor. I've worked in wealth management, and eventually I landed back where I started, just trading the markets for myself. And I also manage an account that is just friends and family. It is a extra money account, put it that way. But I'm done telling people what to do with their savings, and am more interested in helping people make money so that they could live the life that they want to live without punching a clock that they don't want to punch. So
Yeah,
that's about it. You guys can ask me any questions if you want. My contact information is on the Paper Gains thing. So just hit me up and we'll talk.
very cool, man.
That's it.
Yeah, Ryan is. We click pretty much right. Actually, all these guys, the two of them, I just totally grateful just to be able to trade with them. I think all professionally trained. It's a little different. Not as much learn as you go. So here's a quick review, and hopefully it's not just what is an option, right? Again, there's videos and stuff out there. When we're day trading options, and I think this is where everybody starts. Cool. Yes, they're considered lower risk because they're less money, right? So risk, we need to define before we as we go. Risk is defined as how much money do you have in the market? What is your exposure, right? And we'll touch on that later on. So you can have the same or more gains with significantly less money in the market, and so that's what derivatives are all about. It's kind of just that extra leverage. Oh, I got one of our other pros pinging me too. For when we're day trading, just know we are not, and nobody out there is holding these things to expiration. So when it comes to day trading, just know we're talking about minutes to hours, and that's your holding time, right? If it's open that day, it's closed that same day. Typically, it's closed within an hour, sometimes a few hours, but not very much longer than that. The other kinds of trades we'll go through, but just know a contract, it's not, when we're day trading them, it's not really something that you need to worry about having a exposure of being executed on or anything like that, since we're not going to be holding them overnight. So just think of it, conditional contracts. So in terms of the pricing model, so what we're going to go through here is understanding, this is the actual Black-Scholes model. If you want to try and understand it, good luck. Like this kind of like the reaction that most people have. It makes no sense at all. But you can break it down and it makes sense. But like, if you're not familiar with, there's too many things that are really in this process and in this formula that it's not so straightforward. It's not buy the stock when the stock's going, buy the contract when the stock's going up. It's not, buy a put when the stock's going down. It's significantly more nuanced than that. And we'll kind of basically break it into 3 sections. So 3 categories of options, right? In the money, at the money, out of the money. Again, hopefully it's review, and I'm just going to kind of go through this. This is Apple, an old chart of Apple. It was trading at 120 when I put this together a while ago, right? In the money, right? So when we're day trading options, if we want like a small move, maybe it's kind of closer to the end of the week, still buying the shortest amount of time. In the money options are better for smaller moves. There are certain things that you need to be aware of. Mostly it's more cost, so therefore more exposure. A lot of people like it because there's not a lot of time decay, but you also need to be aware significantly wider spreads on in the money options. At the money, this is really kind of like your medium move, right? As we go through here, you'll start to find out, well, at the money options actually decay the most. So they're probably one of the most dangerous kinds to hold because their value decreases of all the types of options: in the money, at the money, out of the money. And these are the acronyms when you see us buying stuff or sending stuff. They will fluctuate by far the fastest. So just be really careful. Most of the times what you'll see people buying is a lot of these out of the money options, and we'll kind of go through exactly why. So that's essentially what we want to do. And so if this is Apple, right? Let's say it was trading at the time of this was at 120, and I had a target, let's say, of 130. I would actually be buying something that's more like a 125 call, and I'd want it to go through my strike and end in the money. So I want to start something out of the money, go through the money and into the money. And that's ideally the situation that we're looking for. Puts, same way, right? If I had say 110, if it was this volatile, it's not really anymore with that kind of market cap. That's what I'd be looking for. Again, hopefully review, but generally speaking, you want to have an idea of where is the stock going and buy something about halfway in between your target and where the price is today, right now. And your ideal situation is when it actually goes through the strike. What you don't want to do is you don't actually want to nail the number right on the head. And if you do, remember, if you nail it, you're right here. You need to take that profit pretty much right away because it's not going to stay there. And we'll kind of go through that as well. Generally speaking, so stocks go 3 directions, right? Not 2. They go up, they go down, and they go sideways. If you started trading in the pandemic or at the end of the pandemic, you're pretty much buying really far out of the money calls and you're cleaning house. The problem right now with this market is that you've essentially figured out by now, well, that doesn't always happen, right? Same thing. You can make a lot of money really quickly, but you have to sell them at the same time. So today we're really just going to go through these 2, buying calls, right? And buying puts. And for day trading, that's where pretty much everybody starts, and also where we stay for day trading for the most part. I sometimes do some credit spreads, but they're typically only 2 to 3 days. But again, intraday moves, the best option actually is to be long calls or puts in a very short period of time, in and out, in and out. And so that's going to be the best bet. Brian actually helped put this together, but when we first started into the Discord community, what we saw was a lot of people buying options on things that we would never trade an options on. So before you go in, let's say you have something that you want to trade, you have to have your checklist. So what is the checklist? Right now, there's something called a bid and an ask spread. If you're familiar with OTC markets and things like that, this is the number one most important thing. And I'll walk you through that. That difference in spread, for me, I'd like to target a 10% difference between the bid and the ask, but it's super important to know that this is what you're looking for. In terms of strike selection, you want to look at something called volume, right? Volume and open interest, really. Why you look at volume is because the higher the volume that you have, that actually should tell you that you're going to have a tight bid and ask spread. So these 2 things here really go hand in hand. I have a video online also about how to tune Thinkorswim. That's our trading platform. Most traders' trading platform also. that I know of, but all platforms can be configured to show you what that volume is, and volume is just today's amount of contracts traded. If you're trading flow, I'm just going to say this, it does not tell you whether or not someone's buying or selling something, so you need to figure that out on your own. Just because there's a lot of volume doesn't mean that they're being bought, and definitely doesn't mean they're being sold either, but you have to figure that out. Implied volatility, this is going to be a huge thing. People say, oh, implied volatility is high, it's expensive. Well, that is true, but at the same time, it's kind of like RSI was my best kind of explanation. So just because volatility is high for a little while doesn't mean that it can't stay high, right? So it's good to know. Just because it's high, I wouldn't necessarily avoid it. Actually, I would just know that what's important is the recent volatility. So we'll show you how to find that and what that looks like. But on a chart, you can really see it. So I'll move this forward. Market cap also. Market cap's a big deal. And this share price, if you're planning to hold anything, we call it swings, right? So if you're planning on swinging any trades, if it's under $20, it's not reliable. Can you make money? For sure, yeah. But in terms of the pricing model, when you don't have these two things, then the pricing model actually becomes pretty unreliable and therefore more of a gamble than an actual dependable trade. So this is the checklist that I would run with, that we run with. Same checklist here. Hopefully you guys can see my screen. I'm going to zoom in. Here's a option chain. So I have it laid out: implied volatility, and these are the Greeks: delta, gamma, theta, vega, volume, and open interest. So these are the things that you would want to have on your option chain at all times. This is the bid and the ask. So if I'm going to click on the ask, then I'm going to buy something. The bid, I'm going to sell something. The difference between these two prices here, that is the spread. So if I buy something for $1,780, because it's, one contract represents 100 shares. So this always has a 100x multiplier, and the stock doesn't do anything. Let's say 2 seconds later, I'm like, I want to leave. I want to get out of it. I didn't want that. Well, the best I can get for it is actually, what is that? $45 less. So I'm going to take an immediate haircut. This is actually a pretty tight spread, and what you'd want to see, and we can see, like, here's the volume, 32,000. So when you're picking your strikes, these are the first things that you look at: the bid and the ask spread and the volume. And so on this chain, what is this? This is Tesla, I think from yesterday. On this chain, you can see, oh, where's the volume, right? Why is this important? So 83,000 here, 48,000 volume today. Open interest, which is here. Open interest means how many contracts were active coming into today. It has nothing to do with today's volume. But what you can take from this is that, yes, the day before, there were 10,000 contracts that were active, meaning like they were either bought or they were sold, and that person still has them. There are 83 new contracts traded, 83,000 new contracts traded today. So whatever this strike was, I would assume it's like, yeah, probably 1120. Sorry. You could say, okay, well, there's a lot of volume here, and there's a lot of volume here. I want to kind of look at this and trade something around these. Either I want to be buying this in and out, but these are the two contracts that you're going to want to sit on or target. If you wanted something short term, you could probably do this, but just know, hey, look, this one right here at the money, you're going to be, if you don't get the move, you're going to lose actually a lot more money than if you're buying this. So have this kind of set up. Those are the first things that you're using, and right now this slide is just about reading the chain and selecting your strikes. So in this perspective, I'm actually not caring about delta. I'm not caring about Greeks at all. When I'm picking my strikes, first thing I'm looking at is this. Not open interest, I'm looking at volume. If I don't have at least a few thousand volume today, I'm just going to skip. This is kind of mandatory to have. If you don't have multi-thousands, then what you could get caught in something we call like a roach motel, where really you might be able to get in, but if you don't have the right execution at the right time, you might never be able to get out. Even if you get the right move, you might not be able to get out for a profit. So choose a very liquid, stock, not in terms of the share volume, specifically in terms of option volume. You guys doing all right so far? Any questions? Again, it's in that Q&A section. We all use TD Ameritrade, yes. Yeah, so that chain, this was Thinkorswim, which is TD Ameritrade's trading platform. There are other platforms if you want to use like Power E-Trade is good. It's pretty clean also. IBKR International Brokers has Trader Workstation, is pretty decent, customizable. There's a reason why we use Thinkorswim, and that's when it comes down to analyzing option spreads. There's nothing like the tools that this platform has. Nothing at all. So again, yeah, take a look at the YouTube and it'll be in there. So, okay, cool. So now you know, what am I looking for on the chain, right? So I'm looking at volume, I'm looking at open interest, I'm looking at the bid and ask spread. And I think, and I'm just going to walk through the mentality of the trade, right? I think, well, if the stock goes up, I should make money. So the next question you want to ask yourself was, well, how much am I going to make? And then, well, what if the price goes down? How much do I lose, right? The reverse is true for puts. Most of the time when people start trading options, they have no idea, like, how much am I going to make? Or I think I should make money, but like, don't you think you should know how much? You really should, right? So it's important. And this is, so first things first, right? When it comes to this, the expiration. So you want to pick the right expiration. You have to have a plan. How long am I going to hold this trade for? And again, we're focusing on day trades. That's what most of the community is actually doing out there. So I figured we'd kind of customize this webinar to that. So day trade, I want to pick what? I want to pick the lowest cost option that I can possibly get that's going to capture the move that I'm looking for. What I'm really looking for is something called gamma. And this is where we move on to options 200. There's a secondary Greek called gamma, and that actually provides exponential gains. What I don't want to be exposed to is volatility. So in terms of the pricing model, there's a big component of the pricing model that has everything to do with volatility or standard deviation, and that is a big deal. So I don't want to have a lot of exposure to that. Meaning, like, if all of a sudden the volatility of the stock changes, I don't want my option to get completely destroyed, or maybe I have a win. I don't know if you've ever bought a call and the stock completely dumps, but your call goes up. Like, that is a effect of volatility. That does happen, but just know it's not because of price action. It's just it goes to show actually how much volatility impacts the price of the options. It's a big deal. If I'm doing a 2 to 5 day, swing trading, defined mostly as 2 to 5 days, give or take, I said 3 here. We'll typically buy, let's say if I want to hold a trade for a week, do I want to buy a 1 week expiration? No, actually. So what you want to do is you want to buy at least 1.5, maybe 2 times the amount of time that you think you're going to need if you plan on holding it. So that goes to planning your trade beforehand. Know how long am I going to hold this, or at least have an idea. Typically, if I'm going to be looking at this longer move, what I can tell you in terms of what you should look for delta, about a 35 delta, generally speaking, will actually capture all this gamma and the move through your actual strike. You do need to be aware of something called delta decay. It's also called option charm, delta charm. I don't know if you guys are probably not familiar with that, but we'll go through that too. If you're planning anything more than a 2-week hold, you do not want to be you don't want to be buying outright options. It's really just going to be better to have a spread trade on. There's a lot of different situations where you can use them, but the reason I wrote this, anything else is a gamble, is because of this volatility, right? So the more time that you buy in an option contract, the more sensitive it is to volatility. And you'll see that in something called Vega, and we'll go through that. But I mean, it's a huge, it gets to a certain point, especially with something like leaps. One, you have a wider bid-ask spread. Two, you're spending more money. And three, the impact that volatility has is actually more of an impact than the price action actually has. So just be really careful. You'll learn how to do spread trades with us. If you want to hold something, you can make very good money doing it. Just know that there's a lot of variance, nuances in the Greeks that come into play with anything longer, and you need to be able to offset that so you don't have those crazy whipsaw type like portfolio moves. So sustainability in the market, I can't be up 50% in a day. I can't be up 20% in a day. I can't even be up 10% in a day. If I see that, I'm like, whoa, hang on. I want to be, small moves, sustained growth. And that's really what you're looking for. Cool. So delta. Everybody learns delta. I'm not going to define it for you guys. I think it's here. Okay. Well, so the stock moves $1. My option contract increases by whatever that delta is listed as. So there are different ways to define delta, though. You can define it as like probability of moneyness, meaning like what's the probability that this will expire at the money. If it's a 35 delta, then the option chain is imputing a 35, roughly 35% probability of expiring at the money. That's one way to define it. A lot of people define it that way. When we're trading options for money and day trading, the biggest thing that you actually do want to do is learn this definition. So synthetic stock equivalent, when you have a 50 delta, let's say, the impact of that option is actually going to be the same as if you owned 50 shares of stock. So if you have $1,000 portfolio and you buy a 50 delta contract, just know, well, the impact that that's going to have on your portfolio, it's like owning 50 shares of that stock. So if you had a 50 share position and you have $1,000 portfolio, you have to know what that risk looks like, right? So be very careful. We use a very small percentages of our portfolios to actually trade. We'll go through that on the next one, but just remember this synthetic stock equivalent. So this is when I buy a contract, the delta is essentially the same amount of shares that I would have if I bought the stock. I can also tell you when we're day trading, I really don't care about percentage wins. Like it looks nice on people's P&Ls and things like that. And I will tell you that we get some of the highest like P&L percentages that you've ever seen, but I don't care about that. What I care about is how much money am I making, right? So just be aware, you want to track dollars, not necessarily percentages. They're great, they're flashy, they're cool, but dollars matter. So quick example. So day trading options. Here's what we want to look at. So this is again this is Apple at $120. Hopefully it doesn't trade there anytime soon, but it might, who knows. When I did this, it was trading at 120. So this is just a quick, here's how we want to actually use the Greeks to kind of give us better returns. If I buy a put, and this is going to the how much money am I going to make? Let's say if it's trading at 120 and I buy a $120 call, it's going to cost me 280, right? This might seem weird, but when I was like learning with like professional crews and everything, we had to do this exercise literally every day. It'd be like, okay, you buy a call, the stock goes up $1, how much do you make, right? So I buy a call, $120 at the money. It costs me $280. Stock moves up $1. I have a delta, here's my delta, 0.51. So 0.51 times 100, because that's the contract multiplier. I'm going to make $51. My new contract value, 280 plus 51, $331. And I've made a net profit of $18 or 18.21%. You should, like, that's $1. It's not $2, just $1. On the reverse, if I buy a put for 119, I have to click this ask to buy, right? It's liquid enough, that's fine. If the stock moves down $1, right, I have a delta of 44, right? So I'm going to make $44. So, this is the wrong value. It's going to be 238 plus 44. I'll change that later. So just on $1, this is your delta, right? $44 you'll make, $51 you'll make. Pretty straightforward. So when you're day trading options, you want to look at this and say, okay, well, if I had to spend $280, here's that same example, to get a 50 delta, right? I do make 18.21%, right? That's what we just factored. So now the question is there a way to take that same bet but make more money just using delta alone, right? Like here's the option chain. Let's see, can you see it? So delta, right? 51 delta cost me $280, $1 move. All right, so is there a way to spend less than $280 and make more than $51 on a $1 move? So the answer is actually yes. And this is what is a very easy thing to do as far as your first way to make a little bit more. You're day trading, remember? So we're not holding this. So what about this 125 call? So this $125 call costs $94 to buy. It has a 24 delta. So about half of that. But is it half the price? No, it's 30% of the price. So why would I spend, let's say I buy two of them, right? So let's say I buy two $125 calls for $94 each, which is a net exposure of $1.88. The stock moves up $1, right? How much do I make? So I have two deltas. My total delta is 48. So I should make $48, right? Puts my new cost at 236. That is a totally different return percentage. It's totally different risk reward. And that is really the first game to learn. Essentially, 125 call, two of them. I'm just gonna look, right? You can look 25 delta, 50 delta. You could do this many different ways, really. 122.50, but this contract here has a lot of volume, so it checks the boxes. 1 penny wide spread, totally checks everything. This is what you want to do, right? Spend less, and I can make more. It's a very quick thing to see once you can get your options chain set up that way. So the next thing you want to know, well, what if I think it's going to keep going, right? And I need to hold it an extra day. Then this thing called theta comes in. So what is theta, right? And why does it matter? This chart here is called, like, this is actually the visual representation of how theta decays in options. On the bottom here, 0 days to expiration, 7 days for, this is DTE, means days to expiration. So if you see any trader sending 0 DTE, well, that means it expires today, right? or something else like that. So just know, hey, if you're gonna, go to the bathroom, you might be in trouble, right? So just close it out before then. Or like if you're gonna buy 42 days to expiration, just know, hey, look, this is the point at 42 days to expiration. Definitively, you should, very well-known curve here. This is when options start to decay. So if I have an expiration that's within this, then I gotta know, well, it's gonna decay pretty quickly. So what I do here, and this is where it gets a little weird, is that people like to trade for bigger sustained moves, and I love that, right? Like if you can catch it, it's amazing. But how do you do that? What kind of structure do you put together to capture that move, right? Do I just buy a year-long contract because I'm not going to have this time decay? Well, I just told you that volatility is a huge factor, more so than the price movement itself. So is that really dependable? No, not really. And the longer time that you buy, the wider that spread gets. Well, you just learned, okay, well, that's my biggest cost. So am I adding, and time has value, right? So options really get their pricing from what is the probability, and we're talking probabilities, right? What is the probability of this underlying asset or stock being at this price by the time this contract expires. So that's the model, right? It's what is the probability of XYZ company closing at your strike price by your chosen expiration time. And the more time you have, well, what happens? The probability becomes higher. So therefore, the cost goes up. And so this is what it looks like. This is Tesla yesterday. And so a lot of us traded Tesla yesterday. I'm sure, I guess, I would hope so. And it was a great trade. But what contracts would you choose to capture that move? And so this is the weirdest thing that I hear, right? And you'll hear it all the time. Buying more time is safer. Like, is it really? Help me understand how buying more time is safer. So I'm going to walk you through this, why it's a big deal, and a little bit of a thing to me. So here's January 14th expiration. This little 2 represents how many days to expiration. 2 days to expiration. I'm going to use this as in Thinkorswim. The yellow represents a weekly. These are called series, weekly series of expiration. The white is a monthly series. So, or you can go out to the February series and buy a strike. And remember, every contract has a 100x multiplier because it represents 100 shares of the stock. So if it's $13.50, well, then it's $1,350 to buy that. So Tesla, screenshot here, $1,620 or $1,106. I had a target at about 1120 yesterday for Tesla. I think it got to like 1118. But we want to think of, what does safer mean? Let's define safer for a second. Does safer mean, safer is the exposure, like how much money am I putting into the market? So we learned, all right, well, if I buy more time, then the contract model tells me it's a higher probability, and therefore it increases the price, right? There's more sensitivity to IV, but I'm just trading short-term price action. And there's also something called delta decay that a lot of people don't even understand. But again, we'll get to that. The longer that you hold, this your delta starts to decay really bad. And I don't care, it doesn't matter where it is, right? So IV here, I don't want sensitivity. I don't want a lot of sensitivity to IV. I do want to be able to take advantage of it. But what I don't want to do is I don't want to pay up for IV, right? So this is IV here. 50% IV on the shortest time to expiration, 54% 1 week further out, 64%, and I'll just zoom in, right? 50%, 54, 1 extra week, 1 extra month, 60%. That's a huge difference. And then time value, let's say I'm going to stick with this 1120 strike. It costs $1,350. If I want 1 extra week, $3,400. Big difference, right? If I wanted 30 days, $8,600, $8,700 almost to buy. So which one is safer? Well, this one's definitely less expensive. And what's the impact, right? So maybe this guy, further out, I have a 50 delta. This is where that delta decay comes in. Same strike, right? This was a 1120 strike. It's 37 days out. Well, this is a 50 delta. If you held it for a little bit, 1120 strike, 9 days out. What's that delta? 40 delta, 46 delta. Where did it go? This is that delta K, right? 0, like the closest to expiration, 38 delta. That's what would happen if I held it, just to my price impact, not anything else, right? Like that, I'm going to have less of an impact. So if I put this together, I took a screenshot. So, and I chart options pretty frequently. So this is actually not the stock, it's the option, right? So this first option, and you could tell this expiration is January 14th call, 1120, right? January 14th, 1120 call, Tesla, right? Second one, Tesla, 2022, January 21st, 1120 call, right? Third one, Tesla, 2022, February 18th, 1120 call. Those are the expirations that we were just using. So 1120, this is trading for 1350. Where does that put this? 1350 is about here. Tesla made a little bit of a move. It made the move. And this contract traded up to 1750. So you would have made $400, right? Hello? Yes. Cool. If I bought one extra week, right? I pay $3,400. So let's say $3,400. Here's 35 was about here. See this similar move here. This goes up to, it's about maybe 37. I'll call it 38. So you would have made $400. Same price impact, right? Weird. If I bought February, right? 1120 calls at $8,685, that is right here. So this is yesterday. This dash is yesterday. This forward is today. $8,600 was right here. This went up to about $9,000. I would have made $400. So help me understand. I'm going to pay more money, but I'm going to make the same. And what if it goes down? Well, it's going to be a big difference, actually. So here's what happens, right? So what's your risk reward? Help me understand why it makes sense to buy any more time than I absolutely need. It in no situation does it ever make sense. So that's really black and white. By the shortest amount of time, I don't want to pay for that extra time value, right? I don't need it. Not when I'm day trading, never. Then you're thinking, okay, well, I got the move. A lot of people will think, well, should I hold it, right? That's a great question. So I have today's price action. This is only midday to like 9 something. Tesla did not follow through. All right, so let's see, right? I paid $13.50. Let's say I bought 2 of them and I sold one at the top and I made my $400. What happens today? So I hold it a little bit. Okay, well, this contract, yes, it completely dumped. And this is where people get confused. They're like, well, okay, I spent $13.50. This just percentage wise completely got destroyed. It's sitting at $200. So I lost how much? I lost, what is that? $1,150. Okay. Let's say if I bought more time and I held, well, I paid $3,400 here. How much is this worth now? Okay, so this is only worth $1,600. That's more than the 1120, right? So not only did I spend more, I lost a lot more. Well, wait, okay, so let's say I went even farther out. I spent $8,700. I made 400. I held one just because I had some profits and I thought, okay, maybe I'll swing it. Okay, this is worth $6,500. You lost over $2,000 by buying more time. So no, right? We don't use more time. We very specific when it's day trading, only the shortest time to expiration. There's never really another situation. If you're just buying outright contracts, do you want to day trade anything other than the shortest time to expiration? Does that, hopefully that clears up a lot of that. And yeah, this, you guys can go back. If you're in Thinkorswim, you can right click the contract and copy it and actually just paste it into a chart. Right click. I use this quick chart function. Great question, Spencer. What about if it's Thursday or Friday? Still get weeklies for day trading? Quick answer, yes, absolutely. And we will go into even more of that. So I want, if I'm a professional trader, what I'm looking for is I'm looking for the best probabilities, odds, and risk to reward. Yes. So just a quick, I live in San Jose, right? Just analogy. And we have these, California, we have these card clubs and they have blackjack tables. And I look at this, I'm like, I will never play over here. So here's how it works in San Jose. If I want to play blackjack at a local card house, I have to pay $1 to receive cards. So if I go to Vegas, I can just sit down and I'll get cards. I put my bet in, I get my cards. And if I get a blackjack in Vegas, somebody tell me what's I think it's 2 to 1, 2.5 to 1, maybe. What's the rewards on blackjack? Probably 2 to 1, let's say, right? 2 to 1 in Vegas if I get a blackjack. In San Jose, I have to pay $1 to receive my cards. And if I get a blackjack, for sure, it's like 1.5 to 1. So my odds are my return is pretty crap, right? So as a trader, what I'm looking for is I'm looking for situations where I can get a 3 or 4x to 1, right? Odds on my bet. That's what I'm looking for. I'm looking for situations where I can spend I don't have to pay up any extra premium for the move that I'm looking to get, basically. If I knew, hey, look, I could pay $1,000 to make $100, or I can pay $100 to make $100. That's what I'm looking for. So no, I don't ever want to have the extra money or the extra risk in there. So what I think a lot of people get confused on is volatility, though, right? So this is time value. Volatility is a different beast, and we will get into that. The quick chart, yeah. So just I can't do that. So right click on the ask or the option in Thinkorswim, and I believe actually I don't know if Steven remembers. I don't even have Thinkorswim up, but I believe it's just send to quick chart, and there's a little sidebar that you can pop out, and boom, it's right there. So we can go through that it'll be in the Thinkorswim. But yeah, right click copy, and then in the chart section, you can just paste it in there. This little box right here, this little box is changeable. You just delete what's in there and just Control V paste, enter, and there's your option. When I'm streaming, I'll have a lot of the options that we're trading actually up right here. If I don't try to have a whole lot of trades on at one time. Sometimes it happens, but this is like one easy way to keep an eye on all of your positions if they're going on all at once. You can actually throw your orders into Thinkorswim right on this chart. Pretty cool. Those are the things like, hey, do you have that capability? You know, we're doing this for a living, so just be careful. So there is a flaw in the option model, and what a lot of people get caught up in is, what is that flaw? So we know, so options have three basic components, right? There's something called intrinsic value that is pretty important to understand. So intrinsic value, so if we'll just use that Tesla contract, 1120 contract. If I buy 1120 call for Tesla and it's trading at 1121, right? My intrinsic value is $1, right? So how do I get that? So it's the stock price minus the strike price. So 1121 minus 1120, $1 is my intrinsic value. Anything over that is your time value or extrinsic value. Let's say your contract's not there. Let's say you have 1120 call and it's trading at 1115. Well, 1115 minus 1120 is -5, right? So it's a negative number. Your contract is comprised of 100% time value, right? So that's the most, what is the most exposed in a contract is that time value, also called extrinsic value, right here, also called premium. Some people say premium meaning like the total value of that's not. So the premium is what's on top of your intrinsic value. So premium is not the total value, it's what's on top of your intrinsic value. So if you're in the money, then you have some intrinsic, and then you have some extrinsic or premium. If you are buying out of the money call or put, and it's out of the money, well, yeah, you could probably call it premium because it's all extrinsic. You have no intrinsic value. So just know contracts will go to zero, mostly designed to that. And no, they don't ever really recover. So you'll start to learn those kind of nuances. So, but extrinsic value is what is vulnerable. So if I have an AMD 150 call, AMD is trading, what did it close out to? I don't know, 135. All of that value is at risk, 100% of it. If I had a 130 contract and AMD closes at 135, but the contract is trading for $700, well, this is what you want to know. $700. So 135 minus a strike price of 130 is $5. So I have $500 or $5 of intrinsic value that's not at risk of being decayed away. The other $200 though, that's very much at risk. And so that's going to come out of volatility, primarily actually, and secondarily theta, time decay. So time value, extrinsic, and volatility are the two things that are more nuanced in the Greeks, right? So there is a flaw, and this is what we take care of, like what we take advantage of, take advantage of in terms of volatility. So the Black-Scholes model is very weird. It's great, but what happens is that the pricing model of options actually assumes that volatility, which is also the standard deviation, so how much the stock moves up or down in an average day, is a constant factor. Well, we know that that's not true. Stocks don't go up $5 every single day or down $5 every single day. It just doesn't work that way. Like it chops around up and down. There will be days when it moves more than its standard deviation and days when it moves less than its standard deviation. What we're looking for is actually a point in time where a stock might be trading less than its standard deviation and about to move more than its standard deviation. That is a situation where you will get exponential gains. So if you have a price action strategy, I'll look for a lot of inside bars. Hopefully, like you may or may not know what that is, but a point where you're at an inflection point of a range that has essentially just been consolidating for some period of time, maybe call it a day or two. And I know that because that last day or two has been pretty flat, that the pricing model is assuming that that's how much the stock typically moves, when I know that's just not the case, right? So those are the situations. It's very hard, like if you're not a professional trader, to just to see those. So I do use some volatility indicators on charts, and I'll just go through this really quick. There are two things. So one thing to note, the volatility factor in the options model is a factor of one standard deviation. So if a stock is moving anywhere more than a single day's range, an average day's range, 14-day average range, then IV is actually going to actually explode, right? So Spencer's stock has a better chance of going outside its standard deviation when above or below its moving averages. Moving averages have zero to do with this, to be fair, right? So moving averages are good in terms of like dynamic support resistance, but it actually doesn't have a factor here. You'll use that for your price action stuff. You may use that for your price action stuff, but for options, it won't have a factor. Specific indicators that you can use. So I'll use two indicators. One looks like, I got a buddy, Brian, who calls it the chicken pox indicator. Cracks me up. But yeah, it looks like a bunch of little chicken pox. Essentially, this is called an ADR, average daily range, right? So average daily range, you can get, and this, I use TradingView. So TradingView has, you can just type in stock. This is a stock indicator, ADR. And you'll have a bunch of, not ATR, average true range is a different thing. That's like an oscillator or something that kind of pops up on the side of it. I like it on my chart where I can see, hey, the average daily range, speaking of, actually acts as resistance or support sometimes. I'm going to pull up a chart. Can you guys see my charts right now?
Yep, we can see it.
Oh, beautiful. I just saw this. So apologies, right? Here's a 1 minute chart. I saw this Microsoft today. This average daily range. I take all these drawings off. So average daily range will show up 2 bars. Let's say you want to trade a 15-minute. That's fine. It doesn't actually matter. It's always in the same place. So this indicator is ADR TradePeng that I'm using, average daily range, free stock. It'll show up like this. I have it settings set to 14-day, and I only have it showing today only. And it'll give you this range. What will happen to an option? And I guarantee if you look up a Microsoft chain, the second that this breaks here, first of all, it acts as resistance and or support, right? So this is resistance here. It's fighting its average move. But the second that this breaks, IV absolutely explodes. So you would have seen probably, 20, 30%, I don't know, 10% minimum increase in volatility or increase in the price of the options, regardless of price action. The second that this thing broke, right? If it started to go back into the average daily range, right, you would have seen that reverse. It didn't, and so you actually would have continued with this expanding range, right? And so this back half here of today's move on Microsoft from 311, call it to this $6, the gain a contract would have gotten on this $6 move is probably 2, maybe 3x the gain that a contract would have gotten from 320 to 315. So this is volatility. It's a huge deal. I also use bands, right? So you could probably look this up. I think it's called like paper gains IV bands. So my bands are a standard deviation of 1. So I know that if a stock is trending more than a single standard deviation at any time, then I'm in an expanding range for volatility. This right here is intraday volatility, right? But trending volatility, whole different thing. Yes, this shows direction, right? Can you trade off of this? Yes, right? You would get it here, you would get it here, right? You would have gotten a short signal at the open today. But what this is really telling you is that, look, if I'm up here and I bought puts on, what day is this? The 11th, right here. If you bought puts on the 11th and intended to close them out on the 11th, you most likely would have lost money, because inside your range, you're actually contracting. So the contracting IV means that the prices are shrinking regardless of what the price action is doing. So understanding volatility, having some kind of indicators to see it intraday is pretty critical. Actually, Stephen, I don't know if I know that you use these also, but you want to talk a little bit about how you use them right now and what you can do with them in terms of options trading?
Yeah. So the one thing that Jason and I like to do, especially for these really quick scalpy intraday trades, once you can see how price is breaking down below the ADR, and it's kind of consolidating for a little bit, and then we get a couple pushes back up towards the ADR. Once it gets rejected right there, that's usually a pretty good signal for us to get back in if we're not already inputs to the downside. Because like Jason was saying, we're going to get even more percentage gains off of that because it's well outside of what its average daily range is. So the IV has to increase, and the further it goes outside of that range, the more the IV increases. So on something like Microsoft, that typically trades somewhere in the low 30% of IV, all of a sudden we get down here, and I'm not looking at the option chain, but I'm sure it was much closer to 40-50%, and you're getting a price increase on that contract by a factor of Vega for every percent in IV that it's increasing. So whereas if that price action just happened to be in the middle of the ADR, you're going to get a standard percent increase on that contract. Whereas now it's also increasing by a factor of Vega, a factor of Gamma, and it is, like Jason was saying, exponentially increasing in value. And I'm sure that would have been much closer to 40-50% IV instead of the typical 30 that it usually is.
For sure. So in terms of day trading, you definitely want to use this or something like this. I'm not saying you have to use what I'm using or what we're using. It doesn't matter, right? But what does matter is that you have something that's going to gauge for you how expensive or not expensive an option is intraday, right? So intraday and trending. So for me, we have these bands. I think you can search paper gains bands and it shows up. And intraday, that's for trending IV. And intraday, I'm using this average daily range. So what this essentially turns into is like, this is like that, hey, I can spend $1 or I'll put $20 down at the blackjack table, and if I get a blackjack, I'm going to get 3x my money. So that's the situation I'm looking for, right? And I also know, hey, this average daily range, yeah, it acts as support and resistance. So this will tell me anybody could probably chart this also and say, hey, by the way, this is a support level that you broke down and then you retested and came back down. Yeah, sure, you could do that too. And I would encourage you to, but this helps as well. But this is, again, just strictly in terms of volatility. What you can also take from this is that if you were thinking, hey, I think it's going to keep going down tomorrow, well, you have to know at this point it's extremely elevated. So what's the probability of this bouncing up a little bit and even coming back into that standard range? If it doesn't make a larger move than average tomorrow, your premium or time value is going to be significantly damaged, and your likelihood of keeping that is pretty low. So you'll be able to see live, right, like what's going to happen.
And just another added confluence to your point there, Jason, that I was just looking at it. The current IV percentile is 94% on Microsoft right now after that move.
Yeah. 94 percentile means like it doesn't get any more bullish.
It's the highest.
Or like it doesn't get any more expensive than that. I think one of the
Right.
guys was just asking for that. And here, I'm just gonna take this and type it into the chat, into your question. Send. Cool. There you go. So intraday indicators, intraday just checks. You want to have volatility listed on your option chains. If you're trading price action in addition to, which you will be if you're day trading, have something on your chart that helps you out, right, to read it. It gives you an extra edge, right? Deciding whether or not I should swing something, right? So let's say you got the win, you made some money, right? I want to think of how much is this going to cost me to hold, and I'm going to try and speed up because I know we're getting a little bit over. So remember, intrinsic, extrinsic value, right? So is the option in the money? Yes. Okay. By how many dollars, right? And what's the excess value of that contract? How many dollars in the money is it? If it's not, then it's all at risk. If it is, then the difference between the quantity of dollars in the money and the current trading price for that contract, that's what's at risk, right? Your time value. And that time value is comprised of volatility. Remember, it's what does the option pricing formula think that the probability of this being in the money or at the money equate to by expiration. So let's say, I think this was the Apple one, right? So we just went through that. You have, here's would be if you had $120 call, and this is Apple trading at 121, but the contract value is $300. This is what you want to pay attention to. Remember, the more time you buy, it would be way more than $300. But that excess value, that's what's at risk, right? So be very careful. And we're thinking of this curve right here. Now I want to think, I have this much excess or extrinsic value. How much time do I have to expiration? What does that rate of decay look like? And what's the recent volatility? And I mean recent, within like weeks, volatility of that underlying stock. So if it's recently been volatile, the odds of it coming back to the mean, reverting to the mean or the average, is high. And then you want to look at how much time do I have on expiration, right? You want to think of it like a percentage, right? So that same 120 call with the stock trading at $121. So let's say this is shown in something called theta, right? Theta shows up here, 0.14. So your 120 call, let's say it goes up $1, 0.14. The value is call it 330. If theta stayed the same, which it doesn't, it's going to be 4%. So think of it in terms of percentage, right? If you had 2, right, and you're out of the money, you're actually going to have a higher percentage decay. So this is why this is good for day trading, but not for swing trading. This is just be careful. It's good for short, quick moves. What else did I want to do here? Oh, I was just saying. So what is cool is that out of the money contracts, and remember that last screen, that last slide showed this, right? This is specifically at the money options. So at the money options actually do have the highest decay rate because that theta, I don't know if you can see that very well. The further out of the money, that theta actually is a smaller dollar amount. And remember, I don't really care about percentages. I really care about dollars. It's a smaller dollar decay, right? It may be a higher percentage. It's a smaller dollar though. So just be aware. You want to kind of manage those Greeks when you're thinking about, do I swing it? Do I not? If what I will say is, if you plan to day trade, keep it a day trade, right? Stick to the plan. Wake up early if you think it's going to go on again. Don't worry about the gap unless you're trading for a gap. Like that's a whole nother thing. Morning volatility. Oops, I won't get into that. But someone had a really good question about days of the week and time, and that's a huge thing, and we'll definitely get into that just before we do. So just quick summary, right? As your option change, as the price of the underlying changes, your Greeks all change, right? Nothing is static here, even though the pricing model thinks it is. Nothing actually is. So that kind of variance, that's what we're using to build an edge on top of our price action. I have to always know, hey, theta is not a constant, right? I need to constantly worry about it. The theta that's displayed on your option chain represents 24 hours of decay. So trading is, I don't know, 8 hours, right? But it represents 24 hours. That 24 hours is actually split up over 24 hours. So if it's 100 delta and I have 8 hours in trading, let's say one third of that is going to go 100 theta. One third of that, $30, is going to be decayed in this trading day, right? I can split it up by hour, and you'll actually see that happen. The biggest factor is not theta. The biggest factor is volatility. That's when people think, oh, I'm getting burned by theta. No, you're getting burned by volatility. Actually, that's 90% of the time, except for the question that we had earlier, which I think Stephen will get to in a little bit. But but again, as your moneyness, or like in the money or at the money kind of status changes, so do your delta, so do your Greeks, and you need to kind of be aware of that. I'm assuming that, like, no matter how much time you buy, if it's at the money, it's always a 50 delta, no matter if it's 2 years from now or 2 days from now. I can spend $100,000 and get a 50 delta, or I can spend $100 and get a 50 delta. It's just how much time I'm willing to spend or pay up front. Do I want to pay for extra time? And then that gamma squeeze part, when you get into like trading options later in the week, those are actually more gamma trades than they are delta, or at least equally gamma trades than they are delta. And that 25 to 35 delta sweet spot, that's actually where gamma increases. So if you can get in there and you get the move that goes through the strike, your gamma is going to increase exponentially along with delta. And that's where you're going to start to see some pretty epic returns. But you do have to be aware of how long is it going to stay there? What's the momentum look like? And it needs to continue to carry that volatility or velocity. Cool. All right, I'm going to move on to, so what I see a lot, like Twitter, Discord, people will put watch lists. I'll put a watch list every now and then. Hey, look, if these levels break, I'm looking at this, buy a call, buy a put, right? So trading the open is pretty, it's a pretty specific thing. And I know, Steven is probably our best trader, or day trader. He's just a freaking badass. So I asked him to kind of put something together. But yeah, Steven, if you wouldn't mind like kind of talking about how do you trade the open, What are you looking for? And entries, exits, etc. If you could jump in on this one.
Yeah, absolutely. Yeah, and to touch on the Twitter and the Discord thing where people are saying, oh, hey, look at buying calls or puts if it breaks such and such level. I think there's a lot of people are too caught up in catching these huge runs at the exact bottom or the exact top right from the open. And they think they have to buy something right at the open to catch this move, which just flat out is not true. Couldn't be further from the truth, in fact. So when I'm trading the open, I have a very, very specific set of rules that I need to follow in order for these types of trades to work, because they are intended to be very, very quick. I'm talking generally, 5 to 10 minutes usually. You can usually capture a decent chunk of percentage increase on a relatively small move. So Monday morning versus the rest of the week, Monday mornings typically have extremely elevated IV, which is, like we were talking earlier, kind of dangerous for short-term positions like this, especially on Monday morning when it's elevated and then can quickly dissipate within an hour.
Dude, I live on the West Coast, so like I might be caught in traffic or something like that. I mean,
I know. I was gonna say you're never you're hardly ever there.
It's 6 in the morning. I think I'll see like 4 a.m. over here. Like pre-market's really moving, really 1 a.m. actually. But yeah, like what I can say in just to note on the volatility. So and I think you have it outlined here in your slide, when there's a gap, right, from the close to the open, we call that an opening gap. Well, that gap, it significantly affects volatility. So the morning is the most expensive time of the day for an option, right? So if you like to swing trade, for me, I'll say open at the close, sell at the open, right? So the open is the most expensive time that the options actually are. I think specifically that first 15 minutes, they're the most inflated. So if you buy something in the first 15 minutes, man, all I know is like, dude, if you're not out in 15 minutes after that, you might be in real trouble, even if you get the move.
Yeah, but, exactly.
Yeah,
and that's the whole point of this. It's intended to capture a quick movement in the direction that you want it to go, and then boom, you're out. It doesn't matter if it keeps going or if you are leaving money on the table. As long as you are getting a piece of the pie, that's really all that's important. But yeah, that's typically why I don't trade the immediate open on Mondays, is because you're looking at stuff that's in the 80 to 90th percentile of IV. So it's a bit more difficult to capture stuff Monday mornings for me personally. I know there's people out there that do it. So that's just one thing to note. I really pay attention to pre-market levels, levels that have actual bodied candles with real movement. Like you can see on that top picture there, how there's actual movement.
So this is the same day, right?
Just choppy. Yeah.
This is
actually Tesla from yesterday.
Okay, yeah, nice. So no after hours here, and then over here you're showing with this gray shaded area that's right. After hours trading, so these pre-market trading.
Right. Yeah. Exactly. Cool. So these key levels that I'm looking at here, I've got that little line, that horizontal line drawn on the top picture to mark the pre-market high, which was initially my first profit target on this. So what I'm looking for here is I'm watching 1 minute and 5 minute charts. I have a Tesla 5 minute and a 1 minute open next to each other. So I'm looking at multiple time frames all at the same time. I am setting this all up ahead of time, having my significant levels marked ahead of time before I even get into the trade, knowing that if it gets to a specific point, I enter here. If it doesn't, I don't do anything. I don't chase it, nothing. If it sets up perfect, then I take it. So the entries and exits, I typically don't wait for a confirmation. If it hits a certain level, I'm in. And then I'm counting on that to reverse. And if it doesn't, within a minute or two, tops 5 minutes, then I'm out of it. This doesn't mean like completely just disregard price action. It just means I'm watching it, and if it fulfills, great. If it doesn't, then I'm out. Cut it for a quick 5, maybe 10% loss. I'm selecting an option contract slightly closer to the money than I would for a normal day trade, but it's still out of the money.
So like 1-2 strikes. I mean, that's the thing. So we're typically trading, you know, Apple, Tesla, things like that have, you know, every dollar has a strike sometimes. So the choice of the underlying that you want to trade, that's a big deal. I think you said something, 20%.
It's still going to be something that's attracting higher volume. It's not going to just be some random like 10-15 or 11-15 strike on Tesla, right? It's going to be something that's attracting the volume, but it's just going to be something a little bit closer to the money.
Yeah.
So
you said something earlier. So like you had, so just your like general guideline, 15% loss in general, pretty much cut. Is that right?
Yeah, like 10-15%. If price is moving against me and I hit 10 to 15% drawdown, I'm cutting it. And then I'll try to get back in. I'll look to see if it'll fit my criteria a little bit later and get back in. But since it's right at the open, like you said, the IV is inflated. So if it moves against you, that contract's going to deflate very, very quickly.
Yeah. What I can say in terms of the IV, so you know, options and Greeks and things like that, that's absolutely my deal. Like the price action and stuff like this trading stuff. I think Steven is just, I'm sorry, he's really good. but what I could say is like 20 minutes, 15, anywhere between 15 to 45 minutes. If I'm really safe, if you want to be safer, like an hour, that whole first hour, essentially what he's talking about, you know, if price moves slightly against your directional bias of the contract, it's going to be an exponential loss. So that's because of IV, right? It's not because of price action. It's because you got to know the whole first hour, it's very inflated. So if you don't get that precision, and this is where that accuracy versus precision, it makes a big difference. If you don't get that precision execution and move at the same time, you could be in for a world of hurt. And that contract most likely won't ever, even if it goes higher or lower, right, depending on your direction, it may never actually recover throughout that entire trading day, especially if it's within its average daily range, right? So just I think that's what he's kind of pointing out, like be fast. 20% in general for all of us, I believe is a good trade, right? Like if I can make 20% in a few minutes to a few hours, I will typically take it. So that's where I'll start selling. And I believe that's also where Steve, half the time Steven will point out a trade and be like, dude, I look at him, like, what? He's already out, man. And I'm like, all right, cool. But you also said something earlier. We're only trying to take it, like to capture a small piece of a bigger move, right? And I think that's pretty critical. There's trading and there's investing. It's very different, right? If you're trading, your goal is to capture a very small portion of a larger move. And that's it, right? So if you catch this small portion from here to here, well, that's your trade. This is probably more than 20, 30% in a short-term contract. In a long-term contract, it's not. So, you know, it's just not. It's the same dollars. It's just a smaller percentage.
Right. Again, that small little move from 1075 up to, what is that? It was 1083, I think. That was almost a 30 or 40% inflation in the contract price that I was able to take advantage of just because of the morning IV.
Yeah.
So the problem with these two is that you almost have to slap the contract at the ask price, and there's not a lot of middling that you can do with these contracts, because if you wait, 30 seconds too long, that contract's already, especially on Tesla, it can already be 100, $150 higher than where you wanted to get it.
Yeah.
So that's another precision thing that you were talking about, is making sure that it's at your level that you mapped out prior, not waiting for confirmation, because by the time you wait for confirmation, half the move is already gone.
Yeah. I think Aaron asked a question too. Can you use inflated IV to your advantage, having bought before market close the prior day, I'm assuming, and profit off inflated IV in the morning? Yes, absolutely, 100%. You absolutely can. You'll see me send signals like that, or send my trade logs like that all the time. I think there was one yesterday. Like, a lot of times I'll open something towards the close for a swing, and it may not be planned as an overnight swing, but hey, if I get that big bounce in the morning and I know that, hey, IV is inflated here, it's better to just to take it down and maybe wait for the close, or wait for another time when volatility is not so expensive. Because what you'll know is that, look, if you get that move, and especially there's a nuance with the weekend theta. So Friday closing is actually like the lowest theta, lowest IV, up to Monday open. Well, that's a 2-day gap in time, and you're like 90% probable going to have a gap on Monday morning. So you can actually play that. Yes, theta does like bleed out over Saturday and over Sunday, but it's not always enough to offset what that gap in IV is. And it's actually typically not. So, well, yes, theta actually does bleed out over the weekend. That opening gap Monday, for the most part, actually offsets that theta decay. Just know it's not going to last for very long. It's that first hour. So as long as you get out within that first hour, you still have an edge. And that's why if you're swinging, then you open at the close and you close at the open, and that's an extra edge, right? If you're long options. If you're looking to like set up credit spreads and things like that, well, total opposite, right? Reverse is true. So sell at the open, right? And close at the close. So like open up a credit spread towards the open. Let's say if it's an iron condor or something like that, maybe you don't know what that is. We'll get into that later. But those are the better times to actually do it. I was looking at the market today. I'm like, okay, I got trades on here that I know I want to flip or convert to a credit spread, and their calls. But I also know that, well, right now the VIX was at like 20. I couldn't believe it was still under 20. I think it closed at 20. That's my gauge. Always looking at the VIX. It's not super elevated, even though all these things are kind of selling off. And the stuff that I wanted to create credit spreads out of, it wasn't really the right time. But I know if I get a little pop in the morning, which I do expect, that will be the pop that I should sell into if it doesn't follow through. So yes, adding the edge will be to sell in the morning, whether it's a credit spread that you're opening as a new trade, or closing an existing net long, meaning you purchased options for the night before or a couple days earlier. The opening, yeah, that's your edge. I think so. That's for the most part like what we have for today. Hopefully that added a little bit. We're going to get into this a lot more actually as we go through. This was strictly day trading, right? So we are going to be going through more than day trading, but I think this is, here we go. The next one, this is called, sorry for the names, securing the bag. So once you get a portfolio of options going, what the next question typically is, well, how do I manage all these positions, right? How do I know, am I over leveraging, right? And what is the impact to my portfolio going to be if I get these right moves, or maybe if that goes a little bit against me as a whole, right? So that's what we're going to go over next week, Thursday, same time. And just hopefully you guys will have Think or Swim by now. By then, we're going to use that platform as the basis of what we're going to be working with. And we're going to be able to show you guys, how do you know how much you have at risk at any time, right? Like if you're in Robinhood or anything else, like you might you're going to have this portfolio options, but it doesn't tell you like if the market opens red tomorrow, how much you're going to lose. You have no idea, right? Like, then that's a really bad place to be, especially if you've made a lot of money in a short period of time. Like, having that early morning wake up and it just all be poof gone, that's the worst. That's the worst feeling, right? So I don't, trying to avoid those kind of situations. Other than that, just to sum up what we're kind of going through, there was a lot of points near the money options, right? We do want to do that. If you're later on in the week, you want to do it with precision entries, and you don't want to trade the open because you don't want to be buying in the open, and you want to be cautious of what your delta decay will actually turn into as you move forward. In the at the money options actually have the highest decay, so a lot of people look at theta. That's a thing for sure, but it's mostly just a thing for at the money options. It's not as much of a thing for out of the money or in the money options. Just a note, right? Check your total position Greeks, right? And that's when we want to start getting into next week, is that looking at position Greeks, looking at portfolio Greeks, and how to manage a portfolio of options, really. And otherwise, if you get the move, just know, hey, look, volatility is on your side when you're net long. It's not going to stick around. So take the profits when you get them. 20% on average is a good win. If you can get a little bit more, yes, that's great. Pretty much what we have, right? So short term, we're looking for small moves that are part of a bigger trend, right? Understanding IV mostly, and a little bit of theta, using the Greeks, gamma, delta to your advantage to create some of those exponential gains on top of this stuff. Those are all things to consider. Get yourself set up on Thinkorswim. Get yourself set up from an options trade chain perspective, so you see all those things. You can go to our YouTube. We have that tuning Thinkorswim video. It's pretty raw, but I think it gives most of the information out there, and it's specific for options. I think we're good. Did you guys have anything else? I'll update the link. All right, guys. I think that's it for now. We will see you next week. Adios.